Good evening, and welcome to the John F. Kennedy Jr. Forum. My name is Megan. I'm a freshman studying biology at the college, and I'm a member of the JFK Forum Committee here at the Institute of Politics. Before we begin, please note the exit doors, which are located on the JFK Street side and the park side of the forum. In the case of an emergency, walk to the exit closest to you. Now, please take a moment to silence your cell phones. And please take your seats and join me in welcoming our guest as well as our IOP student leader, Stephanie Lin, who will be introducing tonight's forum.
Good evening, everyone, and thank you so much for joining us tonight. My name is Stephanie Lin. I am a sophomore originally from Long Island, New York, and at the college, I study applied math, economics, and computer science, and I'm passionate about developmental economics and economic policymaking. It is my privilege to welcome you tonight to the 2021 Albert H. Gordon Lecture. Albert Gordon was a powerful player in the investment community. He helped pick up the pieces of a shattered Kidder Peabody after the 1929 Wall Street crash, and then built the firm into what Forbes magazine calls a powerhouse on Wall Street. In 1985, Gordon established a fund to sponsor an annual Albert H. Gordon Lecture Series in the field of finance and public policy, with special attention to the internationalization of finance. Today, we are honored to welcome World Bank Senior Vice President and Chief Economist Carmen Reinhart as the featured guest of our 2021 Gordon Lecture. After receiving her graduate degree from Columbia, Dr. Reinhart served as the chief economist and vice president of investment bank Bear Stearns in the 1980s, where she became interested in financial crises. She has since brought her expertise to the public sector, where she has served as deputy director of research at the International Monetary Fund, as well as the Dennis Weatherstone Chair at the Peterson Institute for Economics. She has testified before Congress and has been listed among Bloomberg Market's most influential 50 in finance, among many other awards. Today, she is on the advisory panel of the Federal Reserve Bank of New York and serves as a professor of the International Financial System at the Kennedy School. Dr. Reinhart is ranked among the top economists worldwide. Her work in international finance analyzes patterns across financial crises. In 2009, Dr. Reinhart published a best-selling book with Professor Kenneth Rogoff entitled This Time is Different: 8 Centuries of Financial Folly, which utilized data spanning across countries and decades to document the astonishing similarities of the recurring booms and busts that have characterized our financial history. This remarkable work won the Paul A. Samuelson Award and has been translated in over 20 languages. We're excited to extend the conversation today through a discussion on our contemporary economic uncertainties with the high domestic rates and housing prices and the large accumulation of global debt abroad in the wake of the pandemic. And tonight's conversation will be moderated by Professor Jeffrey Frankel, who is the James W. Harpel Professor of Capital Growth and Formation at Harvard Kennedy School. Frankel previously served as a member of President Bill Clinton's Council of Economic Advisors. Today, he is among the 50 top-cited economists. Dr. Frankel is a research associate at the National Bureau of Economic Research and co-chairs the Center's International Seminar on Macroeconomics. Please join me in welcoming our guests for tonight, Dr. Carmen Reinhart and Professor Jeffrey Frankel.
So, it's a privilege to be moderating Carmen Reinhart. Not that she's immoderate and needs to be moderated, but there are many things that I have long admired about Carmen. She comes up with truly original ideas, and then in her research is really brilliantly carries them out. But one of the things that I admire is her knack for coining phrases that then are spread widely. I'm going to name five of these phrases, 3 of which have their own entries in Wikipedia. That's more impressive than a citation count. Though this time is different. We heard in the introduction, the title of the book, co-authored with Ken Rogoff, that they certainly weren't the first people to say the words "this time is different." But I think the fact that the phrase is heard so much in analysis of financial markets is really unquestionably ripple effects from their book, which came out during the 2007-2009 recession and the global financial crisis, which was also great timing. So in addition to the quality of the book, the title and the timing, I think, helped a lot. That's number one. Number two is twin crises, which refers to the simultaneous falling victim to a balance of payments crisis and a banking crisis. Number three is debt intolerance. Number four is fear of floating, which was a takeoff on the book Fear of Flying, I assume it was, if any of you remember that. And number five is financial repression, which was a phrase that was used in the 1960s to describe a development strategy for developing countries. But Carmen appropriated it and completely repurposed it and then used it in a new context, which I will explain a little later, but applies to advanced countries. My plan for the evening is to ask Carmen probably 6 questions. And 3 of them have to do with, and they're all keyed off these phrases. 3 of them have to do with financial markets in the US and other advanced countries. And then 2 or 3, depending on what time permits, have to do with emerging markets. So this time is different. It came out at it was written before the crash, before the global financial crisis, but it came out at the global financial crisis when asset prices were high. Asset prices are high again today. The stock market indices hit a new record on Monday. Bond prices are high, housing prices are high. So that is somewhat reminiscent of 2007. And my first question is, are we in a new financial bubble? It's sometimes been called the everything bubble because it seems to hit so many different assets. Or on the other hand, there are some who claim that the market is, even though price-earnings ratios are high, there's anticipated future earnings from technological innovations like digitalization. So Carmen, are we in a bubble? Do we have to fear a financial crash?
Well, before I get started on that, it's good to be home. This is, great to be here at the Kennedy School. This is home. So I look forward to my return. Now, I do, and as a preamble to answering your question, Jeff, this time is different, really is beyond just bubbles and asset prices. It's the belief that old rules don't apply, or they apply somewhere else, or they apply at another time, whether we're talking about equity markets and price-earning ratios that are historically high, or housing prices vis-a-vis historic trends, or debt to GDP ratios, which I know is one of your questions, or monetary stimulus that does not translate to inflation. There are many guises in which old rules supposedly don't apply. And so if you were to ask me what the risks of a bubble, as in 2008, 2009, I'd say this is a different kind of if there is financial stress, it's a different kind. I think the classic bubble or financial crisis fueled by excesses is you have a lot of credit, you have for a while, a very solid economic performance, housing prices rise, asset prices rise, people extrapolate. And so the belief is that you're wealthier, and if you're wealthier, you're willing to leverage, you're willing to take on more debt. So many of those elements are present here for perhaps a different reason. I think a big driver of the equity market, a big driver of a lot of the over-leveraging that we see, not just talking about public sector now, I'm talking about private, and a lot of buildup on corporate debt, low quality corporate debt, is the expectation that interest rates are low forever. And that this is the new normal, and therefore the old rules that, real ex post interest rates, just to be clear, I mean, the inflation numbers, the most recent inflation numbers were just released. It shows a year-over-year inflation rate of 6.2%. 10-year treasuries are about 1.5, 1.6. Those are very negative real ex post returns. That is fairly exceptional by historic standards. So are we in a bubble? I would argue that a big driver of equity prices, and I'm not I'd be insane to forecast equity prices. I've been wrong so many times that it wouldn't really be worth telling you about this, but that a big driver of the rise in asset markets has been what used to be called the Greenspan put, which became the Bernanke put, and which now we can just call the Fed put. And it is very much driven by the expectation of low for long or low forever. I would highlight that, in all humility, economists haven't covered themselves with glory in predicting turning points. An example of that, ages ago when I was young, a big buzzword was stagflation. And in the late 70s, everyone was projecting that the stagflation mode, low growth, high inflation, was the new normal. And then in October 1979, Paul Volcker came in, really did an exceptional tightening in monetary policy. That was the turning point in inflation. That turning point was not foreseen. I think the real risks now are that leverage and pricing that has been built on the expectation that rates are low forever, we are potentially at a turning point. We don't know how quickly central banks will react. My expectation is that they will react more modestly and later in the process, which we can discuss later. It was not unlike the 1970s in the response to rising inflation. But I think the risks of the 2008-2009 type classic bubble is different now. I think it's inflation was not in the picture back then, and we're not going to talk about emerging markets now, but I would say that the world was also very different. China was growing at double digits during the 2008-2009 crisis. Emerging markets were doing much better. We're in a different situation today, so I hope that semi-answers your...
Well, we'll be picking up some of these themes in the later questions, so I'll just go on to number 2. In your work with Ken Rogoff, you gave a very widely discussed number. 90% of the ratio of government debt to GDP was sort of a threshold that once you go above, once the debt rises above 90% of GDP, you're really in for trouble. At the time you wrote that, the U.S. and other the U.S. was well below 90%, and that I don't know if you had the U.S. In mind at all, but now we're above it. Most recently, 98% government debt of 98% of GDP, and Japan even higher, and Europe pretty high. Partly as a result of the 2020 recession, but not just as a result of that. So my second question is, for the U.S. and Europe and Japan, are government debts sustainable?
The million-dollar question. To be very clear, the paper that you referred to, Debt and Growth, is precisely about growth. It's not about you go above 60% or 90% and you get a financial crisis. It's not about that. It's about a growth slowdown. So the key result was that at levels of debt above 90%, growth slows. And on average is about 1 percentage point lower. Let me say that in the advanced economies, it's really hard to find evidence of a combination on a sustained basis of high growth and high debt. I would point out that, and you asked me more explicitly about crises and sustainability. There are two countries that entered the 2008-2009 crisis with debt above 90%, actually close to 100%. One was Greece, and the other one was Italy. Today, income per capita in Greece is below 22% below what it was in 2007, income per capita. And for Italy, it's about between 6 and 7% below. I mean, so, you know, Greece and Italy don't have reserve currencies. They've been called periphery Europe. So what I'm answering is, within the advanced economies, you asked me about how the high debt levels may unfold. I think it depends where you are in the advanced economy spectrum. I'm not dodging the question, but there are, if you go through the menu of policy options, how do you reduce debt to GDP? Okay, the best outcome, I think we're all in agreement, is through growth, right? But growth itself is not a policy. You do policies to stimulate growth, but growth itself is I'm going to adopt the policy of growth. So what are the options? The options are fiscal tightening, otherwise known as austerity, that can come through lower expenditures, higher taxes, or a combination of the two. Another one, which is less orthodox, is if the debt is in domestic currency, which is not the case for many emerging markets, and it's not the case right now, by the way, for Italy or Greece. You can inflate and erode the value of the debt. But let's not forget, inflation is also a tax. So the first option is straight, fiscal. That involves usually some element of taxes. Inflation is a tax. Financial repression, which sounds really nefarious, but in effect, financial repression is a delivery mechanism of trying to keep rates low with sufficient inflation to deliver a negative ex post interest rate, a negative rate of return if you're a bondholder of government debt. So it's a transfer. Financial repression is a transfer from savers to creditors, from savers to borrowers. And therefore, it's also a tax on bondholders, is a tax on savers. And finally, the more dramatic one, which I would not rule out again in cases, you may recall this, that in 2010, before the Greek debt restructuring, when Vincent and I had written also about Greece looking like this is very much like emerging market crisis. Therefore, emerging market solution, i.e. debt restructuring, is not improbable. That's the most extreme case. That's also a tax. It's a tax on the creditors. So what do I think? What do I think is the most likely scenario for most of the advanced economies, barring those that I think are more borderline? I think it's going to be higher taxes. Let me explain why. At the end of World War II, the advanced economies had very high levels of debt comparable in the aggregate to what they are today. I would argue, in effect, that those levels of debt were much lower than indeed now, much, much lower, because at the end of World War II, public debt was the only game in town. Now we have public debt, we have private debt, which often ends up being a contingent liability of the government, and we have pension systems, which, you know, with a very different demographic and a very different, you know, measure of you know, safety nets at the time, they were underdeveloped. So back then, public debt was what you saw, was what you got. Now what you see is not necessarily what you may get because of the contingent liability issue. So it's a bigger scale. But why do I keep saying taxes? I keep saying taxes because also at the end of World War II, belt tightening and financial repression, and in some cases, particularly like France and in a short period, you know, brief period, the UK had much higher inflation rates. The reason I keep saying taxes as opposed to belt tightening a la end of World War II is at the end of World War II, government spending was dominated by discretionary. Discretionary spending was very important. A lot of wartime spending, which was much easier to reverse than the composition of spending today. Politically, completely different. And so, you know, the fact that expenditures are largely dominated by transfers or interest payments and the like, changes the complexion of the fiscal adjustment. So my answer is, I think the US has a lot of rope. Japan has had a lot of rope. You know, borrowing in your own currency and being a reserve currency offers options of doing a lot more, as we will see when we discuss emerging markets, but also as we see when we discuss periphery Europe, which found itself with the largest IMF programs in 2008, 2009. But do I think this can go on forever? I don't think so. I think a lot of the R minus G calculations, meaning, you know, the differential between interest rate and growth, are very much colored by the fact that interest rates have been in a secular decline. I think I just lost my, can you hear me? There. We got it? So I think that, you know, this goes back to the earlier point of turning points, that, you know, interest outlays have been very benign and are very benign, notwithstanding very elevated public debt levels, but extrapolating from that is dangerous. So bottom line, more taxes.
Okay. None of the choices, I guess, are attractive, except, as you say, faster growth, and that's not a policy.
And I would note that do not take lightly the issue of people say, oh, no, you inflate away. It's easy to, inflate away. Inflation is a tax. It's a very regressive tax. Working with low-income countries, which I will not dwell on right now, highlights just how regressive it is, because it is in the lower income strata where the largest share of the budget goes to food, energy, and basic necessities. So it's a very, you know, First of all, reminding everyone inflation is indeed a tax. Secondly, that it is not the best kind of tax from already an income inequality problem that is very much in the forefront of concerns at the moment.
So you've preempted or answered my third question, which was keying off of financial repression. But just to explain, financial repression was used in the 1960s to describe developing countries who kept interest rates artificially low as a development strategy. Carmen, in a paper in 2011, kind of redefined it or repurposed it to describe what advanced countries like the US have sometimes done in the past, like after World War II, to work down the debt, and might do in the future, she suggested. And so I was going to ask whether you think that's going to be that or inflation or what it was going to be the way we were going to pay down these debts. But I think we've already answered that.
But I do want to say one. First of all, I repurposed this with the blessing of Ron McKinnon, who coined the term financial repression when he was describing a system of very large footprint, official sector footprint, i.e. large central bank footprints in financial markets, coupled with heavier regulation of financial markets and delivering ex post negative or much lower interest rates that would have prevailed otherwise. I would argue that financial repression is not a hypothetical looking forward. We've actually had, it sounds really sinister, but when you look at the features that I've described, the footprint of central banks has skyrocketed to new records. These are new records. If you look at the size of the balance sheet of central banks, if you look at the amount of debt that central banks are holding, this is what Vincent and I have been calling a ratchet effect. They ratcheted up significantly in 2008, 2009 crisis, and have ratcheted up even more during the COVID crisis. So very large footprint of central banks already delivering consistently very low or negative real interest rates. So financial repression has been already part of the story why debt servicing has also been much more modest than you would have expected had you had anything resembling a real interest rate from prior historic periods. And I'll conclude on the financial repression question. Financial repression in the advanced economies, this is under the Bretton Woods system where you also had a lot of regulation, controls, and so on. In the first era, from the 40s, 50s, early 60s, it was negative ex post real interest rates were largely delivered through very low nominal interest rates. In the latter part of the 60s and the 70s, as inflation and nominal interest rates began to creep up, before they, of course, more blatantly exploded, after OPEC, financial repression and negative ex post real interest rate didn't come through having low nominal rates, but through having higher inflation and a lot of inflation surprises. That's sort of in a nutshell the paper that Jeff described.
Okay, well, now we're going to turn to emerging markets. My next question keys off of a paper you co-authored titled "When It Rains, It Pours." I'm not crediting you with coining that phrase, but it was about procyclicality. This is a paper written in 2004. Procyclicality of government fiscal policies and procyclicality of capital flows. So what is procyclicality? That means when a country is experiencing, and especially emerging markets, are experiencing a boom, the government spends a lot, runs a deficit, is able and willing to borrow to finance that deficit, and the country as a whole also runs a current account deficit because directly or indirectly the government deficit is financed from abroad. And so that kind of, you've got capital coming in during the boom, and that exaggerates the upswing. And then when disaster hits, or if it's a commodity exporter, commodity prices go back down, then they're forced to cut back, retrench, and no one wants to lend to them. So that exacerbates the downswing. So that's the procyclicality, and that's the phenomenon that was discussed in the paper, when it rains, it pours. My question is, do you think the situation has changed for many emerging markets since you wrote that paper? The most recent example being that in the pandemic and last year, 2020, many emerging market countries were able to run deficits to not nowhere near what the U.S. could get away with, but nevertheless were able to spend to fight the pandemic and to borrow to finance those deficits.
So, your own work, Jeff, with Carlos Vey, provided, considerable evidence that for emerging markets as a group, procyclicality had declined, and on the fiscal side. And I think that is indeed something that we have seen in middle-income countries. Let me qualify that in separating middle income from low income. In middle-income countries, during the party, okay, between, up until 2014, 15, when commodity prices were high, and emerging markets actually had seen a lot of upgrades in their credit ratings, especially vis-a-vis the advanced economies, which were getting downgraded after the global financial crisis. Emerging markets, indeed, as your own work highlighted, on the whole, were much less procyclical, and the good side of it, of course, was during COVID, many of them were able to undertake stabilization policies that they would not have. This is sort of, saving for a rainy day. Well, the rainy day definitely arrived with 2020. In low-income countries, that wasn't the case. And if you look actually, if you were to do a graph of, and we have this in the next World Development Report, which is under preparation, if you look at the size of fiscal stimulus in advanced economies, in middle-income countries, and low-income countries. In low-income countries, if you look at what happened in 2020 from the strictly fiscal stimulus, you would not know there was a pandemic. There was no, you have outliers, of course, but as a group. And part of the story, they were already in debt distress before COVID. And of the 73 countries, the 73 low-income countries that are eligible for the debt service suspension initiative, which has, suspended payments to official creditors since the spring of 2020, more than half of them are already in debt distress or at high risk of debt distress, except these are not the countries that grab the headline. So now I do want to conclude on the procyclicality question because it's very relevant to the here and now. One question that I get asked routinely, and it is a really hard one, is monetary policy being procyclical now in emerging markets? What we're seeing is Brazil had the largest rate hike since 2000. Mexico has risen, has in Europe, Eastern Europe, ditto. You've seen many, not all, but many emerging markets raising interest rates quite significantly, even before they've really recovered, okay? Because these are countries where the recovery can be best described as tenuous. So the question is that procyclical? And is that the right thing to do, given the fact that those recoveries, they're not really recoveries, they've had some rebound, but per capita incomes are still well below where they were. The flip side of that is it's also in these countries. So the answer would be on the surface of the cycle, yes, you're not at potential output. You still have high unemployment rates. But at the same time, these are the countries where you've had very spectacular increases in inflation and in food price inflation, which I go back to the issue of how regressive this is. And also food price inflation, actually, if you look at social unrest, has been, a trigger time and time again. And so there are elements in monetary policy that at the moment in EMs, not fiscal, in the middle income, not yet anyway, but there are certain elements of the monetary policy side that look pro-cyclical, are pro-cyclical, but they're not also out of the blues. They're not insane.
Okay, well, I've got one more question. I think this will be my last, the fifth question, and it just continues what you've been saying. The phrase we're keying off of here is debt intolerance. The observation in that paper was that emerging markets cannot get away with the same levels of debt that advanced countries can. Emerging markets for years have had mostly lower debt to GDP ratios than advanced countries, and yet investors get nervous about them, that investors are more finicky about emerging market countries. Have they gotten more tolerant, do you think, since you wrote that paper? Or on the other hand, and I'm now going to try to ask a question that ties everything together. Are we going to run out of time? Are the countries living on borrowed time? Will there be a new round of emerging market debt crises triggered by the the Fed raising interest rates? And that sort of ties together what you said when in answer to my first question. This time is different. Are we in a bubble? You seem to be saying that low interest rates had sort of caused the bubble, and that maybe the market was underestimating the extent to which the Fed would tighten. I don't know if I heard you right on that, but regardless, there is certainly a history of Fed raising interest rates and that causing crises in emerging markets. 1982 international debt crisis, 1994 Mexican peso crisis, maybe you count 97, 98 East Asia crisis, 2000 and I don't know if I'm going to count 2008, but 2013, the famous taper tantrum, 2018 when we finally did raise interest rates. So do you think we're in for a repeat of that pattern?
No, not of that pattern. The Asian financial crisis and the taper tantrum came on the heels of a boom. So you had the boom bust. Now we may get a bust without the boom necessarily preceding it. This is not I mentioned that for a number of countries, mostly the low income, but not exclusively, growth and per capita incomes were already on a downward trend even before COVID. So the COVID shock has exacerbated. So do I think there will be a higher incidence of defaults or credit events, debt restructurings? The answer to that is yes. Will it look like necessarily like the taper tantrum or like the Asian crisis? I don't think so. In many cases, what we've had in the last year is already a pullout of many investors from emerging markets, and certainly from the frontier economies, which are the lower income counterparts to emerging market that were issuing for the first time, for many of them, bonds. We've already had significant pullout on that. And let me elaborate on debt intolerance, because it's a real big, also, it has real teeth. Debt intolerance was a paper, as Jeff said, focused on emerging markets and focused on external debt, which is hard currency debt. And this is, the Central Bank of Ghana cannot print dollars to repay debt. Okay, so this is, really debt servicing is a real challenge. Let me give you from the latest international debt statistics. What you see in emerging markets and developing countries as a group is very different from what you see in the advanced economies. I mentioned in the advanced economies that debt servicing costs have remained very modest, notwithstanding rising levels of debt. In EMs with much lower levels of debt, but increasing debt, debt servicing burdens, interest plus repayment, have doubled from 2010. So debt servicing relative to exports. I'm not using relative to GDP because exports is what brings in the dollars, right? Your capacity to service that debt. Debt servicing to exports in 2010 were around 10% of exports. In 2020, we don't have the figures yet for 2021. In 2020, it was more than double that. It was over 20%. So this crowds out, and this goes back to the issue of procyclicality, this crowds out all kinds of social spending when you have large chunks of government revenues devoted to debt servicing. And indeed is a key driver of debt distress. And I do, Jeff, expect more debt distress in the horizon, especially in the context of a possible rise in global interest rates.
Okay. Well, thank you for that, Carmen. So we've now come to the question and answer portion of tonight's event. The forum has a set of rules for the question and answer. All questions should, by the way, when there's not a pandemic on, there's usually students hanging from the rafters and all dying to ask questions. We don't have that today. All questioners should identify themselves and provide their university affiliation. Please ask one brief question per person. No speeches, please. Questions end with a question mark. We're going to be using two microphones. One's there and one's there. We'll be able to alternate between them. And those are the rules. So please.
Thank you. Thank you for being here today and for your remarks. My name is Priyanka. I'm a second-year MPA student here at the Kennedy School and a dual degree with the Wharton School, where I finished my MBA. My question is around the last topic you touched upon, so emerging markets, potential emerging debt crisis. Do you think there is the necessity for some kind of international restructuring mechanism beyond the current ad hoc market practices? And if so, where should it be housed?
Good question.
Excellent question. So, look, I alluded to earlier the debt service suspension initiative, which was by design temporary, but it was geared only to low-income countries, okay? But debt service suspension initiative is not about debt reduction, right? You temporarily do not have to repay the debt, but what you owe comes back and you have to repay at a later date. Now, for many countries, there is already a need to restructure. In that context, the G20 has initiated what is called the Common Framework. And the Common Framework is an attempt, importantly, the largest official creditor to developing countries is China. It is bigger than the Paris Club combined. And
you were, I think, were the first to figure out.
I think we did a workshop a while ago on, but anyway, the Common Framework brings in China, brings in non-Paris Club creditors to try to have an orderly debt restructuring process. Now, I really, if you ask me, orderly debt restructuring is like saying you have orderly riots, okay? So debt restructuring is complicated. Many have argued that the common framework should also be more encompassing towards middle-income countries that need debt restructuring. There is no lack of them at the moment. Argentina and Ecuador restructured in early 2020. Suriname is in debt distress. Belize is in debt distress. Lebanon redefines debt distress. And Venezuela, of course, is as well, and so, yes, there is a need. The problem is, I've studied in a very recent paper called Sovereign Bonds Since Waterloo, studied debt restructurings since the early 1800s. And the classic problem is time immemorial. Creditors want to be repaid in full. Debtors want a haircut. And where I'm going with this is to get to the point where a cohesive international move to do something about debt restructuring comes about usually takes a very long time because you're starting from these polar opposites. The Brady Plan, which ended the debt crisis for many of the middle-income countries, that debt crisis began in the early 80s. The Brady Plan was in 1990, first half of the 1990s. It took about a decade. And before that, you had a lot of trial and error, including the Baker Plan and other plans that did not cut it. My big concern, is that it will also take a long time to get to a cohesive. And for low-income countries, bear in mind it took even longer. The HIPC initiative, the Highly Indebted Poorest Country initiative, didn't come about till 1996, when some of the low-income countries had already defaulted even before Mexico defaulted in August of '82. So yes, we need it. Will it come about quickly? That's not my expectation, notwithstanding the awareness in the G20 that we need to go there.
Thank you.
We have a question at this mic.
Hi, thank you. My name is Yi Yang, HKS MPAID. And my question is around debt transparency, so knowing who owes what to whom. So my question is, why do you think this data is so difficult to find? And what do you see are strategies for convincing creditors and debtors to provide more transparency?
Another excellent question. Actually, it so happens that tomorrow morning, the World Bank is having a big event on debt transparency to issue a new report on debt transparency. So debt transparency has three really big gaps or problems that need to be tackled. One is the issue of hidden debts. Hidden debts are older than the hills, but they take on different varieties, whether, the central bank issues debt and doesn't count it, it's not counted. We recently did a pilot, we meaning the group that works on the debt reporting system, that works in the department that I'm in. That was a pilot asking questions on readiness for issues relating to debt transparency. 54% of the respondents are countries that don't have consolidated fiscal accounts, okay? So a core problem of debt transparency is central governments either do not report because they don't want to, for a variety of reasons, or they don't know themselves that state-owned enterprises are off borrowing with often explicit government guarantees. So the hidden debt problem is a big issue. A co-author of mine, Christoph Trebisch and Sebastian Horn, two former co-authors on the China debt paper, did a paper with Anna Galpern reviewing 100 Chinese contracts. One of the things they found in that study is the prevalence, especially post-2013, of non-disclosure clauses. In other words, countries are being told, you do not report this to the IMF, you do not report this to the World Bank, you do not report this, period. So that is, and all of this is in the realm of hidden debt. The second pillar of hidden debt, and lack of transparency, that's also critical, because look, in the common framework, Zambia is one of the 3 countries that has applied for the common framework, and when they got together, the creditor committee got together, everybody had their own debt figures, okay, which is not a great starting point, all right? But one key element also of stumbling block, if you will, is another part of debt transparency is not just unknown debt, hidden debt, but also what are the terms of the debt. Now, in the basic, bread and butter debt reporting system of the World Bank, you know interest rates on debt, you know maturity, you know currency. But that's not enough if you have collateralized debt. And a lot of the debt that many developing countries and emerging markets have taken on is collateralized. So this already sets up, a pecking order, a seniority order among creditors. And so knowing the granular nature of the contracts is also critical. And finally, and I'll stop here, another area where debt transparency leaves a great deal to be desired is that over the last 15 years, many developing countries and emerging markets have relied much more, and especially during the COVID crisis, on issuance of domestic debt, and which is, you would say this is a good development, that you develop the domestic debt market. So this is not a critique of that trend in the least, and should not be interpreted as such. However, the accounting standards are highly variable, often comparing apples to oranges. Things like government arrears, which are very prevalent in many low-income countries, that are not captured in domestic debt, even though governments also often, especially in debt distress, fund themselves by late repayment and non-repayment. So those are 3 pillars of debt transparency. There is a great, thrust by the G7, to increase debt transparency, but this is not more broadly embraced by all creditors.
So we're supposed to stop at 7. We're getting close to the last questions.
Thank you. Well, first of all, thank you so much for the talk. It was really, really exciting. I didn't know where to start with the questions, but I'm going to ask only one because it's a 7. You mentioned that there was a group of countries that were already in debt distress, and they had very low fiscal stimulus during the COVID pandemic. I was wondering if the World Bank already put together some data on how income inequality was affected in those countries and how vulnerable populations were affected by COVID in these countries with debt distress and very low stimulus packages. Thank you.
Indeed. I am a co-organizer of the Poverty and Shared Prosperity report that the bank does. The Poverty and Shared Prosperity report that was issued late last year showed the first increase in global poverty rates since 1998. So if just to get for you to visualize the poverty rates have declined very sharply up until around 2014, thereabouts, when a lot of the problems we talked about began to set in, declining growth rates, in some case outright protracted recessions and so on. And so poverty continued to decline, but at a much, much slower rate. And in 2020, for the first time, it actually increases, markedly. So, you know, it is easier to destroy than to build in terms of, the new global poor is importantly women in urban areas. You know, women with dependent children in urban areas so a lot of the World Bank programs during the whole COVID pandemic have been targeted to cash transfers. You know, so cash transfers have been a leading form of engagement. In part also to try to deal with, you know, the very evident, by any metric, decline in well-being. Let me say that the poverty, like the per capita incomes, are indicative of a much broader set of issues. An ongoing research theme that I have is about the reversal problem. And this is a reversal to development that's manifest, it's being manifest in what data is available on education, you know, and this what is called often the scarring effects of COVID as these cohorts that have been away from school longer. And again, there's also a reversal related to that in that it has also differed by gender. These are not my areas, but I am learning about how the reversal that I see on the macro side is really quite pervasive when you also look at some of the health statistics. I mentioned education, income inequality within country, not just across countries. The nature of the debt problems that I mentioned earlier also feed into that. If you have, I mean, Nigeria is an extreme because because revenue to GDP is very low by any historic standard or cross-country standard. But you have countries that are spending the majority of revenues on debt servicing, which, of course, does not bode well for other types of social expenditure.
So 7 o'clock precisely. That means that's all we have time for. Carmen, it's been great to have you back at Kennedy School for an evening. We look forward to when you're finished for your stint at the World Bank and we get you back for good. Please join me in thanking Carmen Reinhart.